Hello, investors. Today at Muffet Investments, we are going to have a look at some of the companies benefiting from the Indian economic growth story. The Indian economy is growing at a fast pace, and from our view, India is at the same point where China was 20 years ago when it entered the World Trade Organization. So in 20 years' time, India will be a much bigger economy, maybe not as big as China, but nearly as big. If we take into consideration the growing middle class in India and the fact that India is the most populous country, the implications are enormous. It is important to remember that India cannot be like China, as the Communist Party takes decisions that may affect a few to benefit the larger population. Their power is absolute, but India is democracy, and so getting projects implemented can be challenging. The current Indian government under Prime Minister Modi has, however, taken a number of steps to address the bureaucracy and reduce delays. They have also taken action to improve infrastructure, which has been a big hurdle for India from becoming a manufacturing powerhouse. All these actions taken by Mr. Modi has propelled the Indian economy, and it is growing at a rate of 8.3% and is the fastest growing major economy last year. Today, we are going to look at two companies which we at Muffet Investors think will benefit from the rapid expansion of the Indian economy. Analysis of other companies will follow in future posts. These analysis is based on Muffet views and not investment advice. Although the ideas are based on sound logic, it does not mean that the share prices will increase from the current price. As pointed out earlier, infrastructure development is a key priority for the Indian government to increase logistic capacity to attract foreign investments in manufacturing. India is competing with other East Asian economies for this, and the Indian government has pumped massive amounts of capital into infrastructure projects. Many new ports have been built and proposals are in the pipeline to build more. Highways have been upgraded and new ones are being built to improve connectivity between cities and reduce congestion. Freight corridors are also being built. Steel is an important component in infrastructure development. India is already a significant manufacturer of steel. India is the second largest producer of crude steel with 125 million tons of crude steel. India has vast reserves of iron ore and so does not import iron ore in significant quantities. In spite of being the second largest producer of crude steel, as of November in fiscal year 2023, India imported 4.26 metric tons of finished steel from China. Many Western economists had predicted that iron ore prices will fall, reflecting the problems in the property sector in China. However, in 2023, China imported a record volume of iron ore from Australia, leaving them scratching their head. What they have failed to realize is that China is exporting record amounts of steel to India and other growing Asian economies. They have failed to realize that economic growth will come from Asia and not from Europe. Significantly. For example, Indonesia, which also has a big population, imported record amounts of steel from China as shown in the chart. Muffet believes that this century will belong to Asia and most Western countries in Europe are in industrial and population decline. It is important to take the Asian growth into consideration when making economic projections. The other important components of steel production are coking coal and nickel. India imports both of these in significant quantities. Indian imports of coking coal hit a 5-year high of 47 million tons last year. We now have a fair idea of what India is importing. Now, is there a company that mines iron ore, coking coal, and nickel? Yes, and it is BHP Group. We recommend that you watch our video on BHP Group. BHP Group is an Australian mining company, but also listed in London and NYSE. They have big iron ore mines in the Pilbara region in Australia. Their EBITDA margins for iron ore are a staggering 69%. Although iron ore prices have declined since then, they still generate significant free cash flow at current prices. Their margins on coal is about 29%, which again is very good. However, the nickel operations are currently at a loss, as they bought us minerals for their nickel operations at the peak of the cycle. They are also developing potash mines in Canada, which India also imports. So if you are sold into the Indian growth story, then BHP Group is one to consider. The second company that we have chosen is from an entire different sector. Alphabet Incorporated, the parent company of Google, stands to significantly benefit from India's burgeoning economic growth, a trend driven by the country's expanding digital landscape, increasing consumer base, and government initiatives that favor technological advancements. Firstly, The digital revolution in India, marked by a surge in internet usage and smartphone penetration, presents a fertile ground for Alphabet. With one of the world's largest and fastest-growing internet user bases, India offers an expansive market for Google's core services, including Search, YouTube, and the Android operating system. As more Indians come online, the demand for digital services increases, providing Alphabet with an opportunity to deepen its market penetration and introduce new products tailored to the Indian consumer. Secondly, India's demographic dividend plays a crucial role in shaping Alphabet's opportunities. With a significant portion of the population being young and tech-savvy, there is a natural inclination towards embracing new technologies. This demographic profile aligns well with Alphabet's strategic focus on innovation and its suite of products and services designed to cater to a young, digital-first audience. By tapping into this demographic trend, Alphabet can not only expand its user base, but also engage with a generation of consumers who will shape the digital landscape in the coming decades. Furthermore, Alphabet can leverage India's economic growth through its cloud computing and enterprise services. As Indian businesses grow and the startup ecosystem flourishes, there is an increasing demand for cloud services, data analytics, and AI-driven insights. Google Cloud can position itself as a pivotal player in this transformation, offering solutions that enable businesses to scale, innovate, and compete globally. The Indian government's push towards digitalization, exemplified by initiatives like Digital India, also bodes well for Alphabet. These initiatives encourage the adoption of digital technologies across various sectors, creating opportunities for Alphabet to collaborate on public sector projects, enhance digital infrastructure, and contribute to the country's digital literacy and skill development. Moreover, the growth in e-commerce and digital payments in India opens additional avenues for Alphabet. With Google Pay, Alphabet has already made significant inroads into the digital payment space, and the expanding e-commerce sector provides a platform for Alphabet to innovate and integrate its services across the digital transaction ecosystem. Did you know that 95% of Indian customers use Android phones and Google makes money through the Play Store? Also, in a recent survey, 8 out of 10 respondents said they have used Google Pay for digital transactions. Google's ad revenue in 2023 was 28,000 crores, which is a 12% rise from the year before. Google is also investing $10 billion into the digital transformation of India. In conclusion, India's economic growth presents a tapestry of opportunities for Alphabet Incorporated. By leveraging its technological prowess, understanding the unique dynamics of the Indian market, and aligning with India's digital ambitions, Alphabet can not only expand its footprint, but also contribute to the digital transformation of one of the world's most vibrant economies. Whenever we consider any investment, we should also consider the risks associated with investments. As Warren Buffett famously said, the number one rule in investing is to not lose money. The risks associated with BHP Group is its risk to the slowdown in global economy, especially China, as it is the biggest importer of iron ore. The central bank hiking of the interest rates have also slowed down the Western economies, but not so much the Asian and African economies. If we have a severe recession, then iron ore prices, which is the biggest revenue generator for BHP, can fall from current levels, leading to share price falls. We recommend keeping BHP in your watchlist. The best time to buy a commodity company is to buy when commodity prices are low. We need to see how China's economy does in the coming quarters before making a decision. However, we are bullish for the long term for BHP stock based on our India analysis. Google's stock price has risen almost 90% over the last year, and the risks to their search business can pose a threat to their global ad revenues. We are still overall positive on Google, as their YouTube platform will generate revenue growth, and hopefully their investments in AI will help them generate revenues in other areas. The key is to grow their cloud business, and if they could do that, they are in a safer place. We do not recommend buying Google at current share prices. We wait for at least a 30% correction from current levels before making a decision. As BHP share price has already fallen in anticipation of China's slowdown, we are looking for entry points on BHP. An option idea for BHP is to buy 100 shares of BHP and then sell both puts and calls. The following example is for educational purposes only and not a recommendation to buy share or options. Buy 100 shares of BHP and then sell the January 2026 $65 call, which will give a credit of $5.50. At the same time, sell the January 2026 $45 put and collect the $3.20 premium. Totally, by having this position, we have about $8.70 downside protection. We also get to collect the 8.3% dividend. For the sake of simplicity, if in January 2026 the BHP share price is between the sold option prices, both options will expire worthless. If BHP share price is above $65, then our shares will be called away with 20% profit, and we have also gained another 20% from collecting the sold premiums. And dividend. If BHP share price is below 45, we will be obligated to buy another 100 shares of BHP. We were wrong at our entry price for BHP, but due to our options positions, we are better off than buying just the shares alone. We hope you liked this video, and if so, please like and subscribe and comment. Thank you.